Hello and welcome to the Mutual Fund Show. My name is Neeraj Chano. The next 20 minutes, 25 minutes, we'll talk all about mutual funds. Now, remember the last few shows, we've been trying to get you experts to talk about whether there's a good time to invest into equity funds, whether you should look at, well, even small cap funds. We had a conversation last week talking about how the risk reward might be stacked based on historical experiences about what could happen to small caps. How about talking about the non-equity funds for a change, for a whole show is what I mean, because frankly, if the RBI's moves are any indication, it might be a really interesting time to look at debt funds. I wrote a piece on it as well, I think a week ago thereabouts, but I thought it's best to try and get in experts who actually understand this subject much better to try and assess their thoughts on how does the trajectory look like. So Lakshmi Iyer Johnson right now to kickstart the conversation. In a bit, we'll get in Amit Bivalkar as well as an advisor to talk about what the advisor fraternity is talking about. But Lakshmi, good having you as always. Thanks much for joining in. Hope all is well at your end. Lakshmi, what's your sense when you see these moves that the RBI has done? We'll get to the investing piece in a bit, but what's the overarching sense that you get when you look at all that the Reserve Bank has done and what it could do to rates going ahead?
Yeah, hi Neeraj. Firstly, the RBI did one of the most sensible things of actually advancing the policy decision by almost a week towards the end of March, because failing which the ailing bond market would not really have had much of support. It looks like, given the COVID situation across the world, there have been coordinated efforts made by central bankers. We also have seen a slew of measures, but I think the most important measure to my mind is the targeted long-term repo operations, which is the much needed, I would say, Brahmastra for this kind of a market, which is under almost a complete lockdown, where factories are shut, manufacturing is in part. So I think apart from the rate cuts, which are definitely feel good factors for lowering lending rates and bringing about liquidity via CRR cut, lending to the corporate sector, which has been facilitated by the Reserve Bank of India, is to my mind one of the most important measures. And we only wish and hope if these measures prove insufficient, the central banker will act more swiftly to introduce many more such measures.
Okay, so viewers, remember, maybe I'm saying this slightly later than what I should have done maybe at the start of the show, but I'll try and divide this conversation into two pieces. One is talk about the here and now in the near term. By near term in debt, I don't mean like 3 days or 3 months. I'm talking about between 1 year to 3 years. And then we'll try and talk about the really long term as well, because in the past, we've done shows about what to do if you're a really long term investor in debt and what is the long term trajectory looking like. So first, let's talk about the here and now. Lakshmi, so if that is indeed the view that you have, and yeah, I guess the TLTRO is arguably a really important measure, but we've also seen cut in the small savings rate schemes. Banks like SBI have been the forefront when it comes to cutting the savings rates as well. Does all of this make the relative case for investing in debt funds that much more attractive? First, a broad brush answer, then we'll get to specifics.
No, certainly the banking system is flush with liquidity. If that were to be the case, why should banks offer a higher rate of interest, given the fact that they are the magnets right now, which are actually attracting a lot of monies in the form of savings account and term deposits. Hence, we believe that given the way the bond markets are perched right now, fixed income strategies of varying maturities to suit an investor requirement, whether it's a 7-day strategy or maybe a 1 month, 3 month, 1 year, as the case may be. We believe that this is one of the best opportunities to consider investments into fixed income strategies. Just one word of caveat here, unlike fixed deposits where investors are used to hearing this rate of interest as a fixed one, there is nothing fixed like a rate of interest or a return which is guaranteed in mutual funds. If you keep that in mind and you invest with your investment horizon, I think the potentials of unlocking gains in this category are enough and more.
Lakshmi, is there any concern about inflation in a broad way, inflation rearing its head? Let's talk about up till 3 years right now, that inflation coming back in a meaningful way, taking rates higher and thereby eroding the kind of returns that could come in for somebody who parks money in right now with a 1 year to a 3 year perspective? It could always happen. How is the probability?
See, what you're saying is definitely a live probability over a span of 3 years. But is it a live case or a concern which is going to brew in like today, tomorrow, or over the next 4 to 6 weeks? The answer is no. Or for that matter, over the next 4 to 6 quarters, the answer again is no. World over, there has been a complete destruction of demand across segments, barring maybe some FMCG items. The discretionary spends are really down. So, given that we are not very sure about how high can inflation go, so it looks like the inflation numbers that we saw in India in the last couple of months seems to be the absolute peak for now. It may not crash land in a big hurry because of the supply chain disruption. Some price points of certain items have gone up. However, let's not forget crude oil prices. Our biggest import product is actually on its way lower. So therefore, I don't think investors need to be overtly concerned. Over a block of 3 years, we believe, portfolios which are skewed towards the short end will reprice itself at least 2 or 3 times in a block of 3 years. So the reinvestment risk, which investors would be worried about, what if interest rates were to go up, that gets taken care of when you are positioned in short fund strategies.
And I think it's an important thing that Lakshmi is talking about as well. We'll get more perspective on this piece as well, because remember, like I said, while we're talking about the short term, and in my definition of short term when it comes to a debt fund is not necessarily people who need money, I mean, want to park money for 3 days, 3 months or thereabouts, but largely the range of 1 year to 3 years, and then actually maybe try and assess what is the probability of doing this for an even longer period of time. So that's the other thing that you got to keep in mind. Lakshmi, just one small follow-up, and then we'll get in Amit Bivalkar to try and assess how is it that people are talking about as well when he speaks to investors, and what is it that their receptiveness is. Uh, would you reckon that all kind of fixed income or debt products would be good? Because I think a lot of people in the past few times when they've seen shows talking about debt products or seen segments on the mutual fund show talking about debt products or debt on the mutual fund side, um, ask about whether they should choose, say, a PSU debt fund or a corporate debt fund. Are the recent measures by the RBI making a segment which was hitherto not as attractive become more attractive as well? Are you kind of seeing that?
So two parts to your question, and therefore answers in two parts. One is given the surplus liquidity in the system and the need of the hour to maintain this liquidity, clearly schemes in fixed income which are having maturities in their portfolio in the range of say lower end of 6 months to upper end of maybe 2.5, 3 years, and that would include the typical ultra short-term funds, short-term funds. Yes, you rightly observe the banking and PSU funds, etc., would be the best port of call in this kind of a market scenario. Second part is that given what is happening on the medical side at this point in time, and obviously we do not have quick fix solutions, there seems to be a natural flight to quality. Therefore, categories which have orientation in their portfolios with high grade instruments. And see, when I say high grade, I don't necessarily mean AAA rated, but yes, it's a combination of AAA rated instruments and maybe some high rated conglomerates or public sector enterprises which are high on Government of India holding. I think it's a cluster of these categories which we are observing in the last fortnight or so that investors are taking a fancy to. And that's been our thesis also, that don't try to go away significantly from the trend. This seems to be a fair opportunity where the yields on an absolute level and relative levels are looking extremely attractive. But if you stay the course, interest rate volatilities can be there, no doubt. But if you stay the course, there is no way that you cannot realize the true potential of that particular category.
Hmm. Okay. Amit Bivalkar joins in as well. Amit, we have, of course, have Lakshmi Iyer on the show, but just wanted your sense too, Amit. Thanks for joining in. What's your recommendation right now to people who want to invest in debt products? Is this as good a time as we have seen in the recent past because of the recent moves by the Reserve Bank of India as well?
So I think this is not a crisis in financial markets, but this is crisis of confidence. And anybody who is in debt funds have seen volatility come his way, which was not a recent phenomenon. For us, clearly, if you try to look at people who want to put in money in debt, I think this gives a great opportunity. As Lakshmi mentioned, you have great yields on the banking PSU funds. You have great yields on the corporate debt fund side. And if you're looking at any money which is beyond 15 days, I think you should go up to ultra short term funds. Below 15 days, I think staying in liquid or overnight will make the trick. You need to go and put money into funds which are between 2.5 to 3.5 years of maturity. This point of time, I think market is looking for lower cost of money and availability of money. Availability of money was there, cost of money has come down. So you will see a lot of people, but the gap between haves and have-nots on the corporate space is going up. So people who will need money more critically and who are leveraged will not be getting money. And therefore, the right call to be in highly rated corporate bonds or PSUs. I think we are suggesting people to get into high corporate debt or probably into banking PSU funds, Neeraj.
Amit, the follow-up is, what is it? Are people really talking about this and asking you for options to fixed deposits? And the reason I bring this up is because we've seen small savings rate getting cut. We've seen savings bank account rates from State Bank of India and possibly some of the other banks too coming off. Are people really making those inquiries about, where is it that we get a better bang for the buck? Because clearly my avenue, which was giving me the safest form of returns, is not giving me enough returns to beat my household inflation. Yes, the print inflation is lower, but my household inflation is not.
I think the effect of the lockdown will be visible only in the June print. And what we see is that if you have to go by the rate cut on the small saving scheme, it's because if you have a higher rate there, then most of the assets will go and lock themselves for 10, 15 years in such kind of schemes. So the government wants to reduce it. And that is a clear-cut signal that the rates are going to come down. And when you are going to see rates coming down, then obviously you need to be in an open-ended fund, which will be between 2.5, 3 years, so that you will get that capital gain also on your side. People are more asking for a better option, and people have learned about FOMO, fear of missing out. But I think it is FOBO, which is fear of better option. And people clearly are asking about where they should invest their money in debt. And I think this is a good time for advisors also to have that asset allocation in place, wherein you can get that debt money into low duration up to banking PSU or corporate debt funds.
Okay, Lakshmi, the one small question that came up when we last did a small piece on the mutual fund show about debt was somebody referred to how in the not so recent past we've seen some issues with debt funds, presumably after the IL&FS and after the SL group issues that came up as well. So for select funds, there is a small minor impact. People ask about the safety of investing in select in debt funds by and large. Do you think those issues are, for whatever funds that there were issues, are well and truly behind us now, or could the economic distress that we might see in the coming 12 months because of the lockdown and COVID-19 come back to bite us?
See, Neeraj, human beings are used to being in quarantine only in the last 2 or 3 weeks, specifically in India or world over. But if you look at mutual fund portfolios on the fixed income side, they have been already in quarantine mode ever since SEBI actually announced the classification or the categorization of schemes. So therefore, and what I mean by that is that the risk-taking ability of every scheme is differs, whether it is interest rate risk or the credit risk. Most of the episodes that we have seen in the past 12 to 15 months, are restricted to a few schemes. Within that, they are restricted to not more than 2 or 3 mutual funds. So what the investor is trying to behave is like, Begani Shadi mein Abdullah Diwana. What he or she is trying to do is paint the entire canvas with the same brush. We are of the view that bulk of that pain point is behind us. Of course, COVID related will have its own challenges, which is why these quarantine portfolios, which is sticking to the investment mandate based on a particular credit profile or an interest rate profile, which is on the duration side, works well in this manner. And therefore, I urge every investor, and I tweeted about that this morning also, that if you are going to, follow or follow the course of your investments. You cannot invest for 3 years and look at your NAV in 3 days. That doesn't really augur well. You're best off being in a bank fixed deposit. And last but not the least, you have to listen to your advisor, because in this market, everyone is becoming wiser and sharper, and WhatsApp is becoming their advisor. So if you do not succumb to these two mentalities, I think the past is reasonably behind us. The future is immediately might be looking a bit tepid, but it is certainly not bereft of brightness.
Okay. Okay, yeah, the WhatsApp is becoming the advisor, the WhatsApp is becoming the doctor, and well, of late, WhatsApp is also becoming the government, telling us rules that we didn't know about when it came to the coronavirus as well. Amit, Lakshmi very candidly highlighted some caveats to this piece as well, and right now we are only talking about investing in debt from uh, uh, up to a 3-year perspective. Are there any risks to this story?
So I think you need to differentiate between leveraged companies there. I think many of the biggies also, they do not have capital to run their companies. I would just draw this to say post the paper tantrums and post the global financial crisis. Even then you had seen that the short duration had gone to 1140, your corporate bonds had gone up to 1050, your 10-year government securities had gone up pretty high, and post 6 months after the crisis, and in 3 years time, everybody actually got a positive experience out of debt funds. So if you do a deposit in a cooperative bank, you are not going to look at the NAV on a daily basis. But if you put money in a debt fund, as Lakshmi said, you are going to see the NAV on a daily basis, and on WhatsApp you are going to see, okay, this fund lost so much in one day, negative returns in liquid funds, all of that. The risk today is that suppose there are some commodity companies in your portfolio which are getting impacted, for example, oil. Then should you be aware of those companies in the portfolio? I think the answer is yes. So what are the risks today is that the haves and have-nots, the gap is going to go up in terms of corporates, and companies who are leveraged too much. I think those companies you might see some downgrade or rating action from the credit rating agencies. You will have maybe not loss of capital, but you will have mark to market impact, which might unnerve you. So if you want to not look at such kind of volatility, then you have to just stop looking at your debt fund portfolio for the next 6 months. And if you are a 3-year investor, I think that you should come out winning on this as well. Only thing is you can't find the bottom in equity. This also is a pit, which is a bottomless pit, because of illiquidity of the market. You might have yields which can just spike up in a day or two because of illiquidity. And even now, as we speak, Lakshmi can probably vouch for it, that there are corporates who need to run their companies or have some commitments and pay towards it. You will in fact see in April, even your liquid funds, there will be redemptions from corporates because they want to utilize that money into their own companies. So stay healthy for your own sake in COVID. Stay healthy in terms of your portfolio by looking at the quality of companies you buy. And for that reason, I think you need an advisor who can probably dwell well on the portfolios of mutual funds.
Yeah, I mean, debt buying, viewers, may not be as easy as it seems, because even running a debt product, I'm sure, is very complex, but buying the right fund is a matter of art of sorts. So yeah, maybe have a good financial advisor. Just very quickly, Amit, before we move on to just talking about debt for a slightly long-term perspective as well. Um, Somebody who came on one of the earlier mutual fund shows then happened to talk to me off air and told me that if you are in the highest tax bracket and if you have a fixed deposit, then without missing a heartbeat, go out, redeem the fixed deposit, and park the money in a good debt scheme. Is that sound advice? Can you explain to our viewers why that indexation benefit would help.
So most importantly, even if your indexation is at 3 or 4%, and you are putting money, suppose in a fixed deposit at 7%, and in a debt fund which in 3 years suppose gives you a return of 7%, what typically happens is on a fixed deposit you will pay that 42% tax if you are in the highest tax bracket, or 35% or 25%, while here you will get a straight deduction of 3-4% of your indexation. So 7 minus 4, you are left with 3%, which is subject to tax. On that, you pay a 20% capital gain, which means effectively you pay 0.6. So if you have got 7% pre-tax in a mutual fund, you will get probably 620 to 640 post-tax after indexation with whatever index values will come in the next 3 years. But if you invest that 7% fixed deposit, then on that at 35%, you are going to pay 2% income tax for sure for that year. Here, the tax also comes into play whenever you redeem. It's not like TDS wherein every year you need to deduct tax and pay to the government. So here the tax and the taxation is on my end, wherein whenever I redeem, I can actually pay tax in that year. Secondly, Neeraj, most importantly, if we do a systematic withdrawal plan into any of these debt funds, the tax impact, if you redeem only the appreciation from such debt funds, I think the tax impact goes down to 2 to 3%. So if you just are living off the interest of a fixed deposit, you do a systematic withdrawal plan in a debt fund, your taxation actually will fall to 2 to 3%. I think this nobody offers. I think this is a brilliant feature of the debt product. And definitely with indexation, you are actually earning 1.5% to 2% better post-tax return than a fixed deposit. And therefore, if you are a high net worth individual, you need to come into debt funds rather than stay in fixed deposits.
There are so many people who don't quite understand this or don't quite know about this and take the safety net of a fixed deposit without realizing that it's actually destroying their wealth as opposed to building it further. Frankly, the household inflation of a high net worth individual is much higher than the 4 or 5% return that a fixed deposit would give you. Forget a savings rate number. Okay, we have last 2 minutes or 3 minutes left on the show. Lakshmi, one small question for the slightly longer term piece as well. For people who are considering making, say, a recurring deposit, fixed deposit, or some investment plan which is non-equity and for a slightly longer period of time, is it time to think debt as well? One, indexation, and two, frankly, if we look at India growing to a $5 trillion economy over the course of the next few years, then you probably have the interest rates coming off. We've seen that happening across countries which have moved this curve. And why should India be any different? So is debt also an ideal plan, or debt fund also an ideal plan for somebody who's planning his investment horizon for longer than 3 years, maybe 5, maybe 7, maybe 10 years?
Yeah, of course, without a doubt. So if equity acts as carbohydrates or carbs on your portfolio, if it's the energy boosters, I would say income is actually the protein booster of your portfolio. You will have a blend of these apart from having vitamin G, gold, which people anyway have load of it in India. I would believe that.
I have to come in right now because I somehow cannot get your answers correctly. The feed is just sketchy. I will come back to you for this. Hopefully, we can connect it to a better feed. But Amit, the same question to you, really.
Yeah, I think what I feel is that equity is your painkiller and debt is your vitamins. So even if you're investing for 5 years, 10 years period, you are getting good yields on the 5-year GSEC as well as you're getting good yields on the 10-year GSEC. So if you want to invest, you can straight for 10 years go into a GSEC fund. You have predictability of returns and you can actually stay put there. You will still beat your fixed deposit by 2% on year basis for a long period of time. And mind you, if you're getting 2% extra from a debt product over your FD, that 2% is the alpha what you want to create on your portfolio. I think that becomes a very powerful tool in your hand, that you need to look at debt for long periods of time, because asset allocation, even if you retire, you are going to only increase your portion of debt in your portfolio. So if you're going to keep that 25-30% debt today, and gradually as you retire, you make it 40, 50, 60%, I think buying into long-term bonds like some of the long-term gilt funds where you actually buy a 10-year, a constant maturity kind of product. You buy a 10-year GSEC and just forget about it. I think debt over a long term also will give you definitely that additional extra rather than your fixed deposit.
Okay. And that sound advice. Thanks for that, Amit. Lakshmi, let me just try if we have got you on a better feed. Can you just, I mean, the same question to you. We lost your answer midway. Can you just, for the benefit of our viewers, tell us what your thought are on this?
Yeah. No. Yeah, pretty much similar, Neeraj. I was saying that if equities are like carbohydrates on your diet, it's an energy booster. Fixed income is your protein boosters. And anyways, vitamin G or gold is in abundance in every portfolio. So treat it like an asset allocation platter where you need to have the right mix depending on your risk appetite. This is clearly not the time to shun away or shy away from fixed income. Risk adjusted returns time and again proven that fixed income have delivered these kind of returns. You just need to keep the faith, and more importantly, you need to have loads of patience.
Okay, well, that's a new term that I heard, vitamin G. Who knows? Maybe 10 years from now, we might talk about a vitamin B. Bitcoin, no, I'm not being prophetic. I'm just talking about the various asset classes available. But yeah, but this is interesting. This is a really good conversation. Lakshmi, Amit, thank you so much, both of you, for taking the time out and giving us your thoughts. Really appreciate your time, and stay safe.
The union to secure your future is here. Andhra Bank and Corporation Bank are now Union Bank of India.
How many places can you be at once? What if we said 9? BloombergQuint Live. We are everywhere.
The union to secure your future is here. Andhra Bank and Corporation Bank are now Union Bank